Every mortgage type explained. Fixed rate mortgage. Two neighbors buy nearly identical homes on the same day, yet 30 years later, one of them has paid the exact monthly amount from start to finish. That's the defining feature of a fixed rate mortgage. It locks your interest rate for the entire loan term, whether that's 15, 20, or 30 years. Every monthly payment becomes much easier to predict because the interest portion never changes, making it feel a bit like signing a long-term subscription with a fixed price. Even if market interest rates climb years later, your mortgage payment stays the same. That stability is why many first-time buyers sleep a little easier. Of course, there's a trade-off. Fixed-rate loans often start with slightly higher interest rates than some adjustable mortgages. If rates fall dramatically in the future, you won't automatically benefit unless you refinance. For people who value certainty over surprises, knowing exactly what your payment will be years from now can be worth paying a little extra today. Adjustable rate mortgage, ARM. A low mortgage payment can feel almost too good to be true. And sometimes that's because it's only temporary. Adjustable rate mortgages, often called ARMs, usually begin with a fixed interest rate for a few years before switching to a variable rate tied to broader market conditions. During that introductory period, borrowers often enjoy lower monthly payments than they would with a traditional fixed-rate loan. But once the adjustment period begins, the payment can move up or down depending on interest rates. Think of it like signing a gym membership with a discounted first year before regular pricing kicks in. Some homeowners benefit because they plan to sell or refinance before the rate changes. Others get caught off guard when payments increase hundreds of dollars per month. The loan itself isn't risky. The uncertainty is. An ARM makes the most sense when you have a clear financial plan and don't expect to keep the mortgage long after the introductory rate expires. FHA Loan. Buying your first home can feel like trying to join a club with expensive membership requirements. FHA Loans were created to make that first step a little easier. Backed by the Federal Housing Administration, these loans help buyers who may have limited savings or less than perfect credit qualify for a mortgage. One of the biggest advantages is the lower down payment requirement, allowing many qualified buyers to purchase a home without saving the large amounts often needed for conventional loans. However, easier qualification doesn't mean the loan is free. Most FHA borrowers must pay mortgage insurance, which protects the lender if the borrower can't repay the loan. That extra cost becomes part of owning the home. Even so, for many families, paying mortgage insurance is far more manageable than waiting years to build a much larger down payment. For countless first-time buyers, an FHA loan isn't the cheapest mortgage available. It's simply the one that opens the front door to home ownership. VA Loan. Some of the best mortgage benefits aren't available to everyone. They're earned through military service. VA loans are backed by the U.S. Department of Veterans Affairs and are available to many eligible veterans, active duty service members, and certain surviving spouses. What immediately catches people's attention is that many qualified borrowers can buy a home with no down payment at all. That alone can save tens of thousands of dollars up front. Many VA loans also avoid monthly mortgage insurance, helping reduce long-term housing costs. Borrowers may still pay a one-time VA funding fee, although some veterans are exempt depending on their circumstances. The program isn't designed to offer luxury. It exists to recognize military service by making home ownership more accessible. That's why financial experts often describe VA loans as one of the strongest mortgage benefits available in the United States. When used wisely, they can make buying a home significantly more affordable than many conventional loan options. USDA Loan. Many people hear the word rural and picture farms stretching for miles, but a surprising number of small towns and suburban neighborhoods also qualify for USDA loans. These mortgages are backed by the U.S. Department of Agriculture to encourage home ownership in eligible areas. One of the biggest attractions is the possibility of buying a home with no down payment, something that's rare in the mortgage world. There are income limits and location requirements, so not every buyer or property qualifies. The government guarantee reduces the lender's risk, making it easier for eligible borrowers to secure financing. The interesting part is that many first-time buyers are surprised to discover the home they want is inside a qualifying area. Instead of focusing only on the size of the town, USDA Loans focus on supporting communities outside major urban centers. For buyers who meet the requirements, this loan can dramatically reduce the amount of cash needed to move into a new home. Jumbo loan. Not every home fits within the borrowing limit set for conventional mortgages. Once a home's price climbs beyond those limits, buyers often need a jumbo loan. As the name suggests, these mortgages are designed for larger loan amounts, typically used to finance luxury homes or expensive properties in high-cost housing markets. Because lenders are taking on more risk without certain government-backed protections, qualifying becomes much more demanding. Borrowers often need stronger credit scores, larger cash reserves, lower debt levels, and sometimes a bigger down payment. It's a bit like applying for a much higher credit limit. The lender wants extra confidence that repayment won't become a problem. That doesn't mean jumbo loans are only for millionaires. In cities where home prices are especially high, even an average family home may require one. The loan isn't about buying something extravagant. Sometimes it's simply the only financing option available in an expensive real estate market. Interest-only mortgage. For the first few years, your monthly payment feels surprisingly affordable because you're paying almost nothing toward the actual house. That's exactly how an interest-only mortgage works. During an initial period, the borrower pays only the loan's interest while the principal, the amount originally borrowed, remains unchanged. Lower payments can free up cash for other investments or help buyers manage temporary financial situations. However, that breathing room eventually disappears. Once the interest-only period ends, regular principal payments begin, and monthly bills can increase significantly. It's similar to pressing the snooze button on a debt rather than reducing it. Some experienced investors use these loans strategically, expecting to sell the property or refinance before payments rise. But for buyers who aren't prepared, the jump can come as an unpleasant surprise. The mortgage itself isn't inherently good or bad. It simply rewards careful planning while punishing unrealistic expectations about future income or home values. Reverse mortgage. Most mortgages require you to make payments until the loan balance gets smaller. A reverse mortgage turns that idea upside down. Available primarily to homeowners age 62 and older, this type of loan allows people to convert part of their home's equity into cash while continuing to live there. Instead of sending monthly mortgage payments to the lender, eligible homeowners may receive money as a lump sum, monthly payments, or a line of credit. Interest still accumulates over time, causing the loan balance to grow instead of shrink. The loan is generally repaid when the homeowner moves out permanently, sells the home, or passes away. One common misconception is that the bank immediately takes ownership of the house, but that's not how reverse mortgages work. As long as borrowers continue meeting the loan's requirements, they remain the homeowners. For retirees with substantial home equity but limited income, a reverse mortgage can provide valuable financial flexibility later in life.